Your digital asset portfolio has experienced a significant devaluation. This is the core problem we must address. Let us begin with the hard numbers, as they provide the only solid ground for rational decision-making. 1 year ago, your position was valued based on a WAXP price of 4 cents. That equaled 25 WAXP per US dollar. Today, October 22, 2025, that rate has deteriorated. It now takes about 60 WAXP to equal 1 US dollar, placing the price at roughly $0.167 per token. That's a nominal collapse of about 58%. It is a substantial loss. Acknowledging that magnitude is the first step to a coherent strategy. Translate percentages into dollars. Your initial position consisted of 100 WAXP 10,000 none. Pool ratio: 1 WAXP to 100 none. Each side was equal in value. 1 year ago, your 100 WAXP were worth $4. Your 10,000 none were also $4. Total investment, jar $8. Today, 100 WAXP $1.67. 100 $0.0167. 10,000 none, pegged to WAXP, $1.67. Total position $3.34. Real dollar loss $4.66. This is common across crypto markets. History shows extreme volatility, especially among alternative layer 1 blockchains and their tokens. These assets, often called altcoins, demonstrate high beta, meaning they tend to amplify the movements of the overall market. They capture immense upside during speculative bull runs, but are disproportionately punished during downturns or consolidation. WAXP, a blockchain for Web3 gaming and NFTs, is subject to those dynamics. Key: don't panic at volatility, understand the drivers. Crucial observation: the pool's internal ratio stayed stable at 1 WXP for every 100 none. Important distinction: your loss is not impermanent loss, where the relative prices of the two assets in a liquidity pool diverge. Instead, the market repriced both assets downward in unison. The entire WAXP ecosystem lost value versus the US dollar, and your holdings reflected that reality precisely. Understanding this isolates the problem. You're not facing a flawed liquidity provision strategy, you're facing a bear market for a specific asset class. It is also critical to understand why the None token fell in lockstep with WAXP. The None token exists within the WAX ecosystem, and its primary trading pair is with WAXP. Because your liquidity pool maintained a constant 1 to 100 ratio, the market value of None became inextricably tied to the US dollar value of WAXP. If 1 WAXP is worth 4 cents, then 100 None is also worth 4 cents. If WAXP falls to 0.0167, then 100 None must also be worth 0.0167 to maintain the ratio. The decline in None's dollar value is therefore a symptom, not a separate cause. It is a direct reflection of the market repricing the base asset of its ecosystem, which is WAXP. A common point of confusion for liquidity providers is the distinction between market risk and impermanent loss. Market risk, impermanent loss. It is essential that you understand why you did not suffer impermanent loss. Impermanent loss occurs when the relative price of the two assets in your liquidity pool changes. For example, WAXP, USDC. If the price of WAXP doubled, the pool's automated market maker would sell some of your WAXP for USDC to maintain a 50-50 value balance. You would end up with less WAXP and more USDC compared to simply holding the original assets. Your total value would be slightly lower. This delta is the impermanent loss. In your situation, this did not happen. You provided liquidity to a WXP None pool, and the price ratio between these two tokens remained perfectly stable at 1 to 100. Because the relative price did not change, the AMM had no reason to rebalance your holdings. You still have the same 100 WAXP and 10,000 None you started with, plus any fees you may have accrued. The mechanism of the liquidity pool performed exactly as designed. It maintained the price relationship between the two assets you provided. Your loss is therefore not a failure of the liquidity pool protocol, but a direct consequence of market-wide risk. What you are experiencing is pure market risk, which is the risk that the overall value of the assets you hold will decrease due to broad market forces. WAXP depreciated against the US dollar, None depreciated against the US dollar. This is no different than if you had simply held 100 WAXP and 10,000 none in a personal wallet without providing liquidity. Your total US dollar value would have fallen by the exact same amount. The only difference is that by providing liquidity, you were able to earn trading fees which may have slightly offset a small portion of this market-driven loss. The first and most defensive option available to you is to exit your position entirely. This strategy prioritizes capital preservation above all else. Its goal is to stop any further losses and convert your volatile digital assets into a stable store of value. The execution is straightforward. Withdraw liquidity swap, WAXP for USDC swap, none for USDC, hold stablecoin. You would first withdraw your liquidity from the WAXP none pool, which would return your 100 WAXP and 10,000 none tokens to your wallet. You would then proceed to a decentralized exchange, such as Alcor, and swap both assets for a US dollar-pegged stablecoin, USDT or USDC. This action crystallizes your current position, locking in a value of approximately $3.34. By moving to a stablecoin, you immediately halt the financial bleeding. The primary benefit is certainty. Your $3.34 will remain $3.34 tomorrow, next week, next month. However, this strategy realizes the $4.66 loss and forfeits any potential recovery. The second option is one of strategic inaction. Hold your position. This approach is predicated on the belief that the current low price of WAXP is temporary. The fundamental value proposition of the WAX ecosystem will eventually lead to a price recovery. By doing nothing, you maintain your full exposure to WAXP and none. You are effectively making a bet that the market's current valuation is wrong, that over time, the price will revert toward its mean or climb to new highs. This requires patience and a strong conviction in the long-term viability of the WAX blockchain. The primary reward of this strategy is the potential for a full recovery and beyond. If WAXP were to return to your original entry price of 0.04, the value of your position would climb back to its initial $8. That would erase your entire unrealized loss. Any price movement above that level would represent a net profit. While holding your position in the liquidity pool would continue to accumulate trading fees which, although likely minimal during a period of low activity, would still add incrementally to your token balances. The risk, of course, is that your thesis is wrong. The price may not recover, could decline, or stagnate for years. The third and most aggressive strategy is to buy the dip by adding fresh capital to your position. This is often executed through a technique called dollar cost averaging, where you invest a fixed amount at regular intervals. For example, you could decide to add $1 to the WAXP, so, chu wei, 9 dondiobani im audialbiot cons, and doyan elio aliskira ari WDL pool every week. This offensive maneuver isn't just waiting for a recovery, it actively lowers your average entry price. Every purchase at the current low price of 0.00167 pulls your cost basis down from the original 0.04. The math here is powerful during a recovery. Say you invest an additional $3.34 today, effectively doubling down. That new capital would buy roughly 200 WAXP and 20,000 none. Your total holdings become 300 WAXP and 30,000 none. Your total investment is $11.34, that's $8 original plus $3.34 new. Your new average cost per WAXP is about $0.02711 divided by 400 WAXP equivalent. Now the price only needs to recover to 0.027 to break, even instead of the original 0.04. If it returns to 0.04, your $11.34 would be worth $16, a solid profit. But the risk is real. You're increasing exposure to an asset down 58%. If WAXP keeps falling, you'll lose both the original and the new money. This amplifies gains and losses. It's the opposite of a defensive exit. It requires conviction in recovery and the ability to lose the additional capital. Don't do this with funds you can't afford to lose. This is for high-conviction, high-risk investors. If you think WAXP is oversold and a reversal is likely adding at depressed levels can pay off, but execute with a strict plan. Define how much you'll invest and over what period. Don't chase the price impulsively. DCA reduces timing risk but doesn't remove the asset's fundamental risk. This is the path of highest risk and highest potential reward. Exit preserves $3.34 but realizes a $4.66 loss. Hold keeps full upside and full downside. Add lowers cost basis, but increases exposure. Choose based on your conviction in WAXP, your time horizon, and your capacity for risk. If exiting, consider diversifying stablecoin issuers to mitigate custodian risk. If holding, accept volatility and give your thesis time. If adding, automate DCA and stick to your plan. Cold facts, clear choices. The problem is the asset, not the pool.